All right, guys. Welcome to the next video. Now I want to talk about demand and supply, and we can't talk about demand and supply without talking about mitigations. Because at the end of the day, we want the market to come mitigate our demand or supply zones. So now let's get straight to it. Before I start, remember my name is Dr. Just Prime, and I'm here to educate as much as I can. So now we want to talk about demand and supply areas. Okay, so what are demands and what are supply? There's a particular example that I use. I used to say demand is when you're asking God for something, when you need something from the creator, or you need something from someone, you're basically demanding, you're basically asking. When God now answers your prayer, or the person you're asking for something gives you something, the person has supplied you with what you want. And the reason why you're only begging is because at that moment in time, the person has a higher power or higher authority over you. It's the reason why you're looking up to the person to ask or demand for something. So demand will always push the market upward, while supply will always push the market downward, just like my reference and example that I had given here. This is an uptrend, right? And then the market went up this way, came back down. All right, this here is our first demand zone. Then where this market ends before going up to the next direction is where we call our next demand zone. The market came downwards again, going back up. This area here is what we call our next demand zone. All right. Now the market came up, came down here again, giving us this higher low. Then we have here our next demand zone. All right. Now let's talk about supply. All right, we've had a change of character, which insinuates that the market has already changed direction, going on the downway. And then we had this push down to we had a swing to the downside, a push to the downside that gave us this mitigated supply here, because this touched into this square is why it's called mitigated. It means it has come to touch that particular zone or come to reduce the traction of that particular area. Basically, that's what mitigation means. But demand is that other block that actually causes a push to the downside. And in this case, this is that demand. And in this case as well, this is that demand. And as you can see, each time there's a demand, it majorly gets, what's it called? It majorly gets mitigated. And then we have this one that actually pushed the market, causing this break of structure down here. But in this case, it wasn't mitigated because this next push coming from this demand didn't come and touch our supply. The reason would explain in the coming videos. So I would urge you all to watch all of my videos so you can understand basically what I am talking about here. So now this here also would be your next supply zone, of course, because it's caused the push also to the downside, all right? So we're gonna place this here, yes. So now let's go to the main trend to see exactly what I am talking about. All right, still using this chart. Okay, we have, okay, we're gonna draw the area of supplies. We are going to tell why they are areas of supplies. Now, to me, what area would I call a potential area of supply? Now, any area for me that could cause me or give me a break of structure is the one that is going to give or cause me to have a potential demand or supply zones. And there are criteria in which they must have for me to say, yes, this here is a particular break of structure for me. First of all, I must have my break of structure. I must have my break of structure. I must have my demand zone create an inefficiency. All right. After an inefficiency, it must also give me signs of it taking out liquidity. Must take out previous liquidity. And also must take out, it must take out my previous swing high or low. So according to me, demand or supply must cause the following. So demand or supply to me must cause the following, okay? First of all, it must cause an inefficiency. Secondly, it must take out previous liquidity. Thirdly, it must take out my previous swing high or low. So let's look for a criteria that best fits this. So this is a downtrend, all right? This is a downtrend, all right? Liquidity, what tempts you to actually taking trades in the market? Let's look for meaning of liquidity on a layman term. Meaning of liquidity. You can see it says the available of liquid assets to a market or company. That's one. It says liquid cash. A firm may be unable to pay unless it has peer liquidity. Sorry, a high volume of activity in the market. Okay, I think we can go with that. It says a high volume of activity in the market. All right. Now we can see here that there's a high volume of liquidity in the market because people are trying to place trades in this particular area. So it's all jam-packed. Buyers are buying, sellers are selling, and then it's merging each other, causing a range liquidity in this area. Range liquidity, which we'll come up to later on. I don't want to jump into it. This is a set of liquidity around here. But then if we look closely, we can see that what actually caused or took out all of this demand here is this spike to the downside. So there is a particular candle that must have caused that to her to take out all this liquidity. What is the first opposite candle or the first candle? It will be this for me. That's why I mark this as my supply level at that time. All right. So this area here is what cost me to having that smooth demand that took out all of this liquidity. Now, what is the second criteria? I said that my demand or supply level must have. In this case, we are talking about supply. But what is the second thing I said it must have? Let me bring it down here so we can all see. I said what? Must take out previous liquidity, but firstly, it must create an inefficiency. What is an inefficiency? An inefficiency is the market that is not balanced in the market. We can see from here down here to this place, there are no wicks there. From here to here, there are no wicks. Unlike this, for example, where you have a wick, here, and even this third wick also meets it. As you can see here, there's no space for anything. Unlike here, where you have no wick that touches this end here. That's what we call an inefficiency or imbalance or a fair value gap in the market. So that is that. I can see an inefficiency in the market. I can see it's taking out liquidity. And what else did I say it must do? It must take out the previous swing high or low in the market. Now, in the case of this place, it is what? We're having a supply. So it's breaking structure to the downside. And then where is the last low that is taken out? This is the swing low that is taken out that caused the paper structure. So this is what I call a valid demand, a valid supply area or a valid supply zone in the market. All right, now, did it get mitigated? Let's see. Yes, it got mitigated around here. And what happened? It pushed the price down, but it doesn't have enough strength to withhold the second push coming up. That is why it broke this mitigation here to actually make it continue as an uptrend. But we're not going to dive into that now. We're going to take it step by step. Now, let's look for the next one. We have tons of liquidity here. We call it the trendline liquidity, which we'll get back to as time goes on. This is the trendline liquidity. There's a pool of liquidity. And then what happened? We had this push, massive push to the downside, taking out all this liquidity, causing an inefficiency around here. And also what? Giving me a certain break of structure in this area. All right. So this is also, if this would have been a valid demand zone for me, a supply zone for me as well. Did it get mitigated? This is what caused the inefficiency and the push in the market. Did it get mitigated? Let's see. No, there's a slight rejection here, but I wouldn't count that as it's holding because it actually broke through. So that is another sustainable point of supply. Let's look for another one in terms of demand now, okay? Now, demand, where is that area that caused the demand or pushing market? The same criteria, all right? The same criteria. what are the criteria? It must what? Create an inefficiency. Let's look for, did it give us an inefficiency? Yes, here we have an inefficiency. Or is it mitigated? No, not yet. Or it hasn't gotten mitigated yet. So this area here was the one that caused this spike to the upside. For now, we'll get into it in detail why there are other aspects that must have caused this break of structure in the upside. But at the moment, we can see and tell that this was what caused the push to the upside. So mark this as our demand zone. All right, now let's go for the next one. After we had the break of structure, of course, or in this case, the change of character because it's changing the direction of the market. And then it took out all of this liquidity within this range, taking out this previous swing high, right? So that is why this is a valid demand zone. And then the market came down. The last swing points we had after the break of structure had happened or the change of character had happened was this here. Now, did it give us any point of what demand actually caused an inefficiency in the market? There's no inefficiency here per se. Why? Because we are on the higher time frame. I believe it's going to get, you're going to see so much imbalance on the lower time frame, but we don't want to dive into time frames at the moment. But yes, this was the demand that actually caused the spike to actually break it, to actually break in the structure. As you can see, it hits the demand zone here, broke the structure. It also came back down here, also came back from here. You know, it tried it the first time, couldn't break the structure, then came again to retest for finally breaking and giving us that valid break of structure as well around this area here. So this is how you basically identify your valid break of structure and your demand or supply level. Remember, the first thing it must do is what? It must have an inefficiency. Second thing must take out the previous liquidity. And the third thing was what? It must take out previous swing high or low. That would then cause you to have a break of structure. So this is where we're going to end the class for today. This is where we're going to end the tutorial for today. And I'll see you all on the next video. Thanks, everyone.